Hello, everybody. This is Randy Wootton, CEO of Maxio, and your host of SaaS Expert Voices, where we bring the experts to you to talk about what's going on in SaaS today and what are some of the trends unfolding in tomorrow. I'm delighted to have Dave Woolliscroft join me today, who has 25 years of operating, consulting, and board experience with a focus on B2B SaaS and technology-enabled services companies. He'll talk more about this, but this incredible background. Eventually did a tour at Deloitte where he advised PE firms. He led finance transformations, and he co-founded an internal venture accelerator to help Deloitte build recurring revenue businesses. Grew it from zero to $270 million in 6 years. I mean, extraordinary. He then took that experience and went to a great firm called K1. If you all haven't heard of them, they're one of the best out there. It was there for 6 years, worked with companies that range from $10 million to $300 million. And as our audience knows, that's kind of the sweet spot for Maxio, and focused on finance, pricing strategy, and executive recruiting. And then just a little while ago, he left K1 to start Exit Point Partners. And this is where he's supporting lower middle market PE firms on finance, pricing, and M&A opportunities. Dave, did I get all that right?
You did. Yeah. Thanks, Randy. And thanks for having me here. Very excited.
It's absolutely my pleasure. And because of your background, what I'm really excited to talk about is PE. And we're going to get into the difference between VC and PE, because I think a lot of our companies and CEOs and CFOs that are listening are probably more early stage and haven't thought about PE. So we'll talk about the broader context between the two assets classes, and then what does it mean to prepare for a sale to PE, how to make that successful, and then what does it mean to live under a PE regime. I'm doing that right now, basically, and I think the things changes for the company, for the CEO, for the CFO when you're working for a PE firm, and it's good to know that before you go in. So I'm excited to dig in.
Cool. Me too. Yeah. Great topics.
So let's start just broadly. How do you think about the difference between VC and PE?
So I guess, and I think also there's kind of like bootstrapping as part of that too.
Sure,
being
right.
able to kind of like grow under your own steam.
Yep.
Yeah.
Totally. Yep.
So and I think quite often it comes down to the preference of the founders, and then also potentially the TAM that you're looking at. I think most VCs are looking for those opportunities where there's a large TAM to be able to go and address a target addressable market with where the company is going to really be able to get to scale, potentially have an IPO as an exit. On the PE side of things, they're not necessarily, they're potentially more able to invest in vertical SaaS with smaller TAMs. And then, it becomes like your perspectives on what the outcome is going to be, I think. PE, I think one of the great things with PE, and when you're working kind of like with PE sponsors, is that it's very rare that they have losers. As we all know, kind of on the VC side, actually maybe only 1 or 2 in 10 kind of like get to like get really good exits. And so it becomes a little bit associated with your risk tolerances too. But, both have a lot of benefits depending on your own personal preferences.
And in general, I think we find VC firms are more early stage when there still is more financial risk, business model risk. People are working on product market fit. Like I've heard often the early stage VC funds, they're betting on a horse and a jockey. And whereas PE firms tend to come in, I think, when there's a little bit more scale. I think of like Series C and then beyond, and there's the product market fit. They probably have a replicable sales model, and I think of PE firms helping to bring a level of discipline in scaling. Would you say that's a fair distinction, or too broad?
I think that's that. And within your life cycle, kind of within a company, you could be doing kind of like one or all three of those, starting bootstrap, becoming VC backed, and then PE could be a potential exit path for a VC-backed company. A lot of founder kind of like bootstrap businesses become really good targets for PE companies too, as they say, reach $10, $15 million in ARR, because there's usually a decent level of profitability there too, which is also what they're looking for.
Right. I do think that's one of the orientations as well as VC. I think things have changed over the last couple of years, in particular, with moving from growth at all costs to efficient growth. But in my experience with VC it's primarily around let's invest to grow, and less concerned with, okay, so how profitable are we? Because they would say, hey, any money you have is go invest in your growth plays. so that you can capture the market. So to your point, if you have a big TAM, like you want to be first mover, or you have some new capability, new technology, you want to get out in front. So invest, invest, invest. I think that's been modulated with the markets and the rise of inflation and interest rates, where you now have VCs also reading from the Bible of efficient growth, rule of 40 models. But I think PE firms, the other thing I think about PE firms is they often have a set of operating partners. So in addition to the investing partners, they have people who are experts in go to market or finance or technology. And so they bring those people to bear. At one end of the spectrum, the really big guys like Tomo Bravo and Vista have an entire consulting division that they use to come in and say, hey, here's our playbook, called the VCP, I think at Vista, the Value Creation Playbook, and this is how we want to do it. And
That's
here are the
right.
people who help you going to
Yeah.
do it. Whether you like it or not, they're gonna strongly recommend you to do X, Y, and Z. Whereas I think the VC, they may have like a people operating partner who helps you with recruiting, but I haven't seen that many VCs with a large operating group. Do you find that to be true, or what's your experience been?
I don't have so much experience on the BC side, but there's even flavors within the PE kind of world too. There are flavors to those different types of operating partners, and that is something to consider as you're potentially looking to see who to work with. Who comes with a very defined playbook where they're going to want to really execute on that. Some people's operating partner approach is a former CEO who's been in their seat, probably had like two or three exits in the past, potentially with that PE firm, and they're a really good, both bridge between the company and the investment team, as well as a good coach to the CEO. And then you've got the other model, like you were talking about too, Randy, where there's actually these functional specific experts, and they're able to face off with different leaders within your own teams and bring best practices to bear at that point in time too. It definitely becomes one of those things where I think also depending on the firm, sometimes they go through cycles of having more of one or the other, and then you'll see a variety of companies that are, or PE firms that have the variation of those approaches. And I won't necessarily say that one thing is better than the other, but I think it is really important to make sure that you understand the relationship with those people as if you are potentially talking about an exit to a PE firm, you're thinking about the people who do you want to work with, because that you will work with them a lot.
We'll come back to that in a second, what makes a great PE firm. But just before we leave that point, I think the other thread you're pulling is that VC is often a minority stakeholder. And so someone uses a VC, the seed round, the Series A, the Series B, Series C. So you may have four different VCs sitting around the table who've come in at different valuations and have different orientations. And so that's a little bit of like managing the UN. Often PE firms take a majority interest where they buy the whole thing or a majority of it. And so that, for example, in battery, we have three different portfolios. We have one which is VC, which is the preponderance of batteries firms of 140. They have a majority owned growth equity portfolio, which is what Maxio is part of, and that's about 30 companies. And then they have a pure PE, which is more solving for EBITDA. In our case, to your point, we have Chelsea, who's the lead investor, Dylan, who is the principal, and Jason, who is a multiple-time CEO, not a battery employee, but a friend of battery, who's done it and is acting in that role that you described. It's he's there as a coach, he's there as an intermediary, because it's a much smaller board. So sometimes
Yeah,
if battery and I don't agree around what we need to be doing, then Jason comes in and plays a little shuttle diplomacy. And so I think
yeah.
it's a great model when you have an operator who can help translate and who's impartial and can kind of say, hey, here's some things to think about for both of us. So I think that's great. And
They're quite
so when
often
you think
part
about making a great
therapists too.
and part therapist, amen. I absolutely hear you on
Yeah.
that. I have played independent observer or board member on a couple of boards, and I do that for the CEOs that I work with. I think there's a level of empathy that you can provide. At the same time, you can kind of say, in this case, I think the board member is actually making a good point, and you probably want to take it on.
Yep. Yep. I would agree.
So with that, we were talking about what makes a great PE firm, and you were talking about it being partner dependent. What were some of the other things that you found? Like K1's one of the best. Like what makes K1 great and the other ones that are in that category and tier?
I mean, I think kind of PE firms where they've got a really good focus on growth is important. It is still that profitable, efficient growth. It's how do you establish the playbook and then work out how to double down on it. It is kind of the introductions that they can bring you in the market to. Potentially, it can be with strategics. It can be with partners. It can be with other potential acquisition targets that you're going to look at over time. That ability to really help kind of, you get the network effect of them working across many companies. And then one of the things that is, I think, really valuable from a PE perspective is that they've seen many movies, and so they've
Yeah.
been through lots of situations in the past. Sometimes, you might not think that they've actually, and they may not have operating experience on the investment side. Of course, and they don't, but they have seen lots of movies. They have seen lots of
Right.
situations, and you can get kind of like that repeatability in those indicators, and so they ask really good questions.
Yeah, that pattern matching, I think, and
That's
they're
right.
Excel jocks, and so they're gonna help you figure out what metrics are going in the right direction, which ones are going in the wrong directions, and then to your point, they pattern match in terms of what's worked across other companies. I think the other thing you had mentioned in our pre-brief was the relevant experience of the partner. So one of the reasons why I took this job at Maxio was Chelsea had been in the office of the CFO for, I don't know, 12 or 15 years, right? She's forgotten more about the office of the CFO than I will ever know. And so there is a lot of value to having deep seated expertise around the table, especially if you don't come from that industry. So I grew up in MarTech ad tech. I wanted to shift over into a different industry. And I've been here two and
Yeah.
a half years. I'm learning it. But I think there are things where she's been on the board of companies like, I think it was Anaplan and Avalara and a couple other ones that she helped through their growth phase. So she's seen what it takes to take fintech or office of the CFO tech through the different stages, and she's seen success on the other side. And there's a lot of value in to help charting the course.
Yeah, and you sometimes you see firms with that specific investment thesis where they want to be investing in this particular verticals or horizontals. But then to your point, you end up with partners or other principals that just naturally gravitate towards the same things, and they're making investments in repeated space. And you get the benefit of that kind of like learning and journey that they've been through before. And so,
Yeah,
yeah,
I'd say that's the last thing, and I think this is true at the VC and the PE. If you're raising money or preparing for a sale, which we'll shift to in just a second, you want to make sure you know who's going to be on your board, because often they bring in the superstar, and then they bring in the principal or the analyst if the deal's not that big, and it's that person who's on the board. But wait, no, I want to go with Joe or Susie, who knows everybody and knows everything, and I think that's another important consideration is who actually is going to be there side by side with you through the ups and the downs and see it to a transaction. So with that, maybe we can shift to preparing for a sale to a PE firm, because I think a lot of companies that are uh, bootstrapped in particular, but even if they're kind of early stage VC, may not be ready for what comes to sell to a PE firm. So what are some of the criteria? I mean, this is where you're advising a bunch of PE firms as well in terms of what their targets should be. What are you finding? What's your pattern that you're matching?
yeah, and we also advise kind of founders as they go into those sales, and so the diligence process is going to be hard. It's going to be a challenge. It always is, and it's because they're really going to get into the data, and so being able to like have a few things like predictability in your go-to-market execution. Sale process is probably going to take longer than you would expect, and you're going to provide targets or like expectations on what bookings you're going to close. You want to be able to make sure you hit those targets, because otherwise you'll have lots of other conversations around that, and it sows, various seeds of doubt about whether it's the market or whether it's about the executability of the team. So you want to have really good go-to-market execution, just a good muscle established in how you're going to do that. You've obviously got to have good ARR fundamentals. They care a lot about predictability of churn, and if you've got below benchmark, whether you're for enterprise or for SMB, that's going to be a challenge, and that's going to impact your valuation, because they really want to have that obviously sustainable and repeatable base there. The profitability is important too. And this is sometimes where you can actually do something to really help prepare yourself to have the most successful exit if you're going to go that PE route, if you're thinking ahead 12 to 18 months. But they are going to they are thinking about the rule of 40. So the rule of 40, I'm sure you've covered it before, is that ARR growth plus the EBITDA margin. And so obviously the growth rate is going to be there, but the profitability is like, how do you work out, like, to just take out inefficiency that already exists in the business? That's going to eventually get ferreted out under kind of PE ownership anyway. So work out how to do it yourself and get some value for that. The other big lever that I see on the profitability side for founders to remember as they're thinking about getting ready for an exit process to PE is to think about pricing, because quite often pricing that you're going to market with, you probably determined that a few years ago, maybe just as you were starting to go out to market. You haven't really thought about, what levers there. There's a lot of fear that exists with founders in changing pricing. But when you've got a really good solution and you've got high retention rates, you've actually quite often got a lot of pricing power. And so how do you work out how to do something where you can maybe not just do like a one-time price uplift, because that's seen then as being more of a one-time profitability improvement than an ARR improvement. But how can you kind of like continue to increase ARR year over year through price increase? That drops down to the bottom line, and obviously kind of like also improves your growth too.
Great comments, David. A couple of just clarifications. I think.
Sorry, there's one other one. The obvious one that I forgot is the finance guy, and it's just like your data quality. Like, you've got to make sure that you've got like your financial data like in order, especially with the ARR schedule, that it's there by customer, it's clean. Investment banks will often help you get ready and clean up, like just as you're going into a process. But on the flip side, like when you're on the PE side investing, you can kind of tell that the bankers have pulled this together. And you can tell that it's not really the way that the company runs the business. So try to build just like good, agreed data quality. Like everyone agrees that bookings is the same thing from sales to finance, your other types of metrics that you run the business with. Just make sure that you've built some discipline around that before you start to go into a sale process, and you'll come out looking really good.
That was like an unpaid advertisement for Maxio, because that's exactly what we offer. We should have a flashing logo during that time. But that was my experience when I was at Percolate. Was my CFO, I may have told you the story, my CFO wanted to buy this technology. It was called SaaS Optics, one of the legacy products of Maxio. And I was like, oh, God, no, we have too much internal software. There's no way we can take on yet another software. What are you talking about? It's just a spreadsheet. And he said no, and he bought it. And typical CFO ignored the CEO and did what he wanted. And we got it, and it changed my life. And changed my life because it actually influenced the way we ran the business. So we went from spreadsheets, trying to figure out, after we spent 6 to 8 days closing the books. At the end of the month, we spent another 6 to 8 days trying to figure out what the heck happened through the spreadsheet. Someone would fat finger a cell, and we'd be, pulling our hair out, and we'd slide into the board meetings, hoping it was right. From that to what I have at Percolate and today, so it's October 7th, I don't know, third business day of the month, given the weekend. We already have our ARR sorted, our revenue sorted. We're looking at, I was just talking to my sales rep right now in terms of what our win rates were by segments, what was the discount that was done by segments, and already teasing out what happened and what are we going to do about it? What's our next pricing strategy, to your point? So I do think, like, whether you buy it from us or not, having a system that allows you to do deferred revenue, allows you to do the ARR roll forwards, to do the customer cohort analysis is to your broader point. That's what the PE firm is buying. They're buying revenue streams. Well, they're buying cash. They're buying EBITDA. So they need to trust that all the financial statements are accurate. But really, those are governed by GAAP. And as long as you have a pretty good CPA on staff or a controller, you're most likely going to be okay. You're going to argue over, does customer success go above or below the line in gross margin? But 99.9% of the stuff is sorted. But in the world of ARR, it's the world of Wild Wild West. And people, to your point, have different assumptions around bookings and gross retention and magic number and all these different things. And so having those sorted out before you even go into the process, so you have a couple of quarters of predictability. And that's what I was going to say about the go-to-market execution as well, is it's not just even in the process, because I find a fast prospect process, I mean, there are always exceptions, right? But normally it's 4 to 6 months. It can go longer, it can go shorter. So you're going to get through 2 quarters during the process, but you kind of want to have, I think, at least 4 quarters before going into the process where you have predictability on your go-to-market execution. Like you have a sense for your sales velocity. You understand what your win rate is. You started to, if you have multiple segments and multiple products, you're able to break it out to really be able to show, and then your AE attainment and all those ratios like AEs to BDRs and how many do you have there. And so I think having some practice at running the go-to-market and with visibility, as if you were, if you have investors, you should do it with your VCs. But what is the discipline you need to run that business is spot on. And pricing, I'm so glad you brought that up, because I think that's one of the major levers that PE firms pull that not many VC companies do necessarily. It's they think about growth through new ARR, or they think about growth through expansion being seats or modules or jumping divisions. But you have this whole other component around what we call monetization, where you think about your offer, the price, the package. And that's exactly what you were saying. Like if you could start to show that you're proactive in terms of your pricing strategy, it really shows the sophistication, I think, of the executive team.
Yeah, that's right. Yeah, and it really is it's an example of that discipline. It's just like there's a regular whole company motion, because like also a price increase is a whole company motion from sales through to customer success and the back office team, and it's got to happen every year. But then, and it is one of the rare things in the Rule of 40 where if you do it right, you get the double benefit. Because, like I was saying, it's obviously going to impact your profitability margin because you're able to generate more profit. But if you're able to do it in a repeatable way, you get the benefit of it in your growth rate too, versus it being kind of discounted. So, so there's actually very few things that you can then do, kind of like where you get the double fillet.
That's great. The double barrel shotgun, or some other great metaphor. Your last point, I think, spot on. One of the things you as a founder, CEO of a company, this is your baby. You think it's beautiful. You go into a process of the PE firm, they're looking to find things that are wrong with it because they're trying to discount and get a better valuation from their perspective, an asset at a lower price. And so any of these things where it doesn't kind of pass the sniff test, or they have to spend extra time on it, they will drill on you on that and negotiate down the price. Now, if you are the best looking product on the market and you've got lots of bidders, then a competitive process is always better. But we got to pick one at some point, and then you start going down that chute and you're with them for 4 to 6 months. And if you pull out of it, then everybody else who was at the beginning of the process is going to think, well, what was wrong? What did that PE firm find that was dark and deep? And so you never get another shot at that, first impression, whatever, that first go, I think. And have you found that in terms of, I don't think there's any PE firm that's going into a process saying, let me look for reasons why I should pay more for you.
No, generally not. I don't think they're necessarily looking to work out why to pay less, but they are looking to see, like, do I believe in this investment? Because they've obviously got a fiduciary duty to their LPs. And then I think everyone in PE knows that, and they're focused on their own returns. That's kind of like the business that they're in. The biggest indicator of success for a potential return for them is the price that they pay for something at the beginning. So they've got to make sure the fundamentals are right. And if you invest in a business where you think that maybe the product fundamentals are good, but perhaps you don't have confidence in, or you find out that you don't have a repeatable sales motion afterwards, you can lose a year perhaps in your investment cycle, because you discover that, and then you've got to hire a new sales leader and then build a new approach, and all of a sudden, that's another year kind of like within the hold period, and that obviously costs money. So they want to make sure that they are really comfortable about the fundamentals of the business. And then as a founder, the important thing to remember is that you can't be in every meeting talking about every aspect of the business. They're going to talk to sales. They're going to talk to product, and they're going to look at the engineering side of the house. They're going to talk individually with the CFO. And so that's where, just that, again, the rigor around execution and data commonality amongst the team, and there's a data-driven business, will hold you in good stead. Because if everyone's talking about the same metrics in an internal management meeting each week, you can trust then that by the time they go and talk to a potential PE acquirer, that they're still going to say things in a consistent fashion.
It's a great insight and great segue to our next conversation about life under a PE, because I do think it's very, very different. When I was a VC back company, Percolate, we had Sequoia, GGV, Lightspeed, First Round Capital. And look, I haven't done a bunch of these, but those are some top tier firms with great partners on the board. We would meet once a quarter for the board meeting, and we would do maybe once a month touch base. I'd write an end of month report and you'd give them an update, but it wasn't a full board meeting unless we were about to go through a process, and it wasn't regular. It was periodic. With the PE firm, I'm meeting with them every week. I mean, at least,
probably at least
every other week,
right?
at least. Yeah, right. No, and I'm on, bat phone with the lead partner. So maybe give us a little bit of context and perspective on what does it mean to move into life under PE.
Yeah, it's good. And I think this is one of the things that I see as being, for some people, the biggest change. And it can be quite a shock for some founders as they kind of move into life under PE. But the active board is the largest one, and so that ranges from typically I think there's a touch base at least once a week with either an investment partner or an operating partner. There will quite often be monthly operating reviews. And I actually recommend all my clients to do monthly operating reviews with their PE sponsor, because it just gains that regular alignment. And that's not just going through the financials, that's going through the whole operational metric set for the business on a monthly basis. And then you've got the quarterly board meetings that happen too. And then you've got the other reporting that you do, which is generally, again, kind of in a PE environment, I suggest people provide weekly reporting of key metrics. It's what's happening for leads, pipeline changes, bookings, upsells, churn, view of cash. We'll come back to cash in a minute. But it's those kind of key heartbeat metrics for the business, the same thing that your management team should be looking at on a weekly basis. It's good to just give to your kind of a PE sponsor team, because it's one of those strange things about the human psyche, I guess, that if you don't know what's happening, you worry. But if you receive the information on a regular basis, then they may ask you a question as a result of it, but they're not necessarily thinking the worst because they don't have access to the information.
Right. So, oh gosh, I could tell my executive team to listen to this part of the call, because I think they're Randy, you are over functioning in terms of the amount of information we produce. But what I always tell the team is so we do a weekly forecast call. We do the Red account call and do a weekly forecast call on Fridays. By Monday, all of those numbers are wrapped into 4 or 5 slides, which capture what's going on with our pipeline, what's going on with bookings, what's going on with renewals. And we send that to the board with cash. So we also include the 13-week cash forecast. And to your point, it's a predictable set of metrics, and I'll throw in some commentary, and then that happens every week, except for if we're going to go into a board meeting or the end of the quarter. We also do an end of month review, which I'm working on now for September. I've got the narrative going. People are adding comments and stuff, and I walk through more details around what happened on the bookings, what happened on the churn, what happened even our costs in terms of P&L hosting costs. We had some things going on, what's playing out there, and you never want the board to be surprised. But if you get that out, right, you get that financial data out, and then you provide the data on a quarterly basis. Ideally, what ends up happening, I think, is you've had the conversations around the financial metrics, and then you get to talk about the business. If you show up at the quarterly meeting and you haven't been keeping people up to speed, they're going to take you to math camp on your financials. And they're going to say, okay, show me now the P&L, what's going on here, double click on this, do that. And then you're going to go through the ARR reporting. And so I don't think you ever get a chance to have a conversation about the strategy or some of the things you want to dig in on and want their feedback as advisors. And so I think this broad theme of PE is about predictability, meaning you're regular and consistent. You call out what's working, what's not. And I think to your point, it's almost you don't want to, it's in the PE world, you're not out of sight, out of mind. If you're out of sight, all of a sudden everyone's okay, what's going on?
That's totally right.
So,
it's a couple of things you made me think of there, Randy. One thing on board meetings, by the way, sometimes the default kind of under P is that every function is going to talk about their stuff, kind of like in a board meeting. And I generally don't like that. It should be probably in the deck that goes out in advance for
You're right.
people to review. But if you've kept everybody up to date, kind of like you, the CEO, get to talk with the operating partner or the investment partner and decide what's going to be a good, interesting, useful agenda in that meeting.
Yeah.
And it
Yeah.
may just be like just focused on marketing for this one session.
Yep.
And then that's good, like, because it's valuable to you. So like you do this other regular stuff, to your point, so then you can direct those board meetings to what you care about. And really the whole thing, it's just like hopefully skills that you've learned kind of early in your career of managing up. Now you do have
Right.
a boss. Like if you were a
Yeah.
founder before, now you've got a boss, and like what's on their mind? How do they become successful, which should hopefully be aligned with you? And then how do you make sure that they don't have to worry about what you're doing, so they leave you alone? That to me is always the art of managing up. It's like, how do you give your boss enough so they leave you
Yeah.
alone to do the things that you're good at doing?
That's great. I want to come back to that just in a second, but the comment around the rhythm of the business. So we do as I was mentioning, we do a quarterly board meeting. It's 3 hours. We do a monthly board meeting. I don't bring everybody to it. It's actually a monthly check-in call, and I will do topics. So like in October, we're going to talk. We have a new head of marketing. She's going to come in and give an overview of what's going on with marketing, what's working, what are the trends we're seeing, what are her bets for
Great.
Q4. We're really focused on expansion. So my head of customer success is going to come in and present that. So it's a very focused conversation around those specific topics. I will have provided the end of month summary report for September. So we'll touch base on that, but I don't want to spend any time on that because these are the two things that are really important. That happens monthly. The quarterly board meeting happens at the end of the quarter. In between the monthly meetings, I do or try to do a one-on-three, I call it, where it's the three other board members and me, and it's an open agenda. And I come in with a couple of things I'm thinking about, but it's usually not a lot of prep or materials. And they have things they want to ask me about without everybody else in the room. And so I do think having that balance of really formal quarterly board meetings where you're going through and you're approving the minutes and you're making sure you're, especially in the VC world, but you're sort of overseeing the fiduciary responsibility versus the monthly topical versus the just informal check-ins, and just know that's going to be part of your life. And the point that you're making earlier as a CEO, needing to be comfortable that the board is also going to be engaging with your executives directly. The CFO
Yep.
and one of the principals are going to be talking all the time, right? We have an M&A conversation where I have other people involved, and they're going to reach out and they feel perfectly free to do it. Reach out to whom they want when they want. Now we try to keep each other informed, but you're not going to be the conduit of all information. And so, again, to your point, if you have scorecards and a predictable rhythm and everyone's singing off the same sheet of music.
Yeah, you know that's really good, Randy. You know when you do those monthly spotlights and you bring people
Yeah.
into those, do you end
Yeah.
up having to coach your team to make sure that they're sharing the ugly stuff as well as the stuff that's going well?
Yeah. Yeah. Absolutely. And I do spend a lot of time. Yeah, I think if anything I've learned, like my natural instinct is I'm one of those rah-rah guys and I want to show you why everything's possible. And I do think that's probably true for a lot of early stage CEOs as well. Like they started a company with a vision for how they could change the world. And they received
Hmm.
a lot of no's and people were telling me it was impossible. And they had to through force of will and brute force just get their product out the door and he or she getting people to buy into it. And then you move into this model where you've got to be very self-reflective and self-critical. And I call it managing the exceptions. So if you have a scorecard, use scorecard with metrics and targets, you always start with what's red. And you say, here are the things that aren't working. These are why we think it's not working. Here's our mitigation plan. Here are the things that weren't working last quarter. Here's the status. And it's like you're just in this world of negativity, right? Whereas you want to be spending time talking about everything that's green. But I think in general, my experience with investors is they assume you're going to do good stuff. What they want to
Yeah,
know is what's not working, and then they want to try to be helpful and
that's
dialogue
right.
and work through those things and whiteboard. And it's kind of like, hey, look at my dirty underwear. But in some ways, like I'm going to mix the metaphor here, but yeah, it's like, yeah, you want them to help you clean your underwear, right? Because, and I do find that is the biggest value is as a CEO. There's so many times where I got some pattern matching because I've been CEO 3 times, but I don't have the pattern matching that they have sitting on 20 boards over the last 10 years. And you just want some help. You want to say, hey, look,
That's
this
right.
we're having this struggle. I'm not sure why. Here's what I think it is. And to be able to lead with that as the vulnerability and humility to say, I don't have all the answers. Can you help co-lead with me? I think is one of the greatest skills that executives have to learn stepping up onto the C-suite. As you move from being the person with all the right answers to being the person who can feel comfortable enough saying, I don't know why this isn't working, but here are 3 ideas and what I think I'd like to do. You always have a recommendation. What do you think? And then inviting people to be part of the solutioning.
Yeah, then that's good. Yeah, one other quick thing there is, well, having a scorecard for each kind of functional leader is super important. I agree. It is kind of a red flag if you can't come up with a scorecard. I've seen that before. So like
Right.
do that, and then the other red flag is don't change the scorecard each quarter because you don't like the answer. So
Right.
um,
Amen. I do think that's a great comment in terms of we in the companies I work with, we try to create a year long operating plan, and the operating plan has a set of objectives. It has a scorecard. It has some metrics, and we think the metrics are the right metrics. And you can argue about the targets, or the targets right or wrong. But if you thought deeply about these are the leading or lagging indicators of success, then those shouldn't change. You can talk about
that's right.
why they haven't improved, but you don't want to change your metrics. It means you haven't done the hard work up front to think about what are going to be indicators of success or things going off the rails. So with that, with PE, we talked about the more active board. We talked about the lots of questions. And for the CFO, the role really changed in the finance department. We talked a little bit about the reporting and the timelines, but what else would be your recommendations for CFOs that are getting ready for a transaction?
Well, so I think the thing to realize is that the game, changes pretty substantially for finance once you go into PE ownership. When if you're founder bootstrap, you might be running it on a cash basis, and that's totally okay because it's all about how do you just like manage the bank account and you see it grow. VC, you've got less check-ins that are happening. In PE, kind of like it's a pretty serious game right from the get-go for CFOs, and you've got to make sure that you level up both from an accounting standpoint perspective. You've got to be able to make sure that you've got the back office that will support the business growth. And then there's going to be a lot more questions around FP&A. And from an FP&A perspective, the other thing that I usually think of as part of FP&A is cash forecasting too, because the other thing to not forget is that there will usually be debt involved in a transaction at some stage. And so you never want to be the cause of a cash surprise. The Friday afternoon call to an investment partner saying, "Yeah, like we probably can't make payroll next week. Could you send us some money?" That's a very difficult conversation. So you've got to like have a really good focus on cash, and then you are going to get a lot more questions, and there's going to be a lot more rigor around the data that's coming out of FP&A. So you've got to make sure that you're resourced appropriately, and that definitely means quite often that you need to hire FP&A potentially for the first time. You should make sure that you've got a reasonable kind of level of FP&A resources for the business, and you might need to address some of the systems kind of like within your businesses too. Whether that's a full ERP implementation, whether that's just like a really good revenue and billing subledger like Maxio, the types of things that will actually really help you do your job with confidence and reliability. You talked before as well, Randy, about like I was just gonna say like you talked before about like how you got 3 people that are involved, kind of like in your business. I assume that's not including all the kind of associates and senior associates that are
That's right.
also looking at your data on a regular basis, and they're getting into
Yeah.
stuff, and they will find things that are
Yeah.
wrong, and you don't want them to
Yeah.
find things. As a CFO, you don't want them to find things that are wrong too often. They will do, but not
Right.
too often.
Yeah, because there's Excel jocks, right? Like their whole
Yeah,
remit of those early stage analysts is to run models and do the due diligence and find what's not working and sniff it out because then they look like the hero, right? So I think you're absolutely
that's
spot
right.
on. When we talked earlier, you were We talked about when CEOs flame out at PE firms, what are the top two reasons? You just called it out. One is not knowing the cash. And the other one, which you are alluding to, is this: they haven't figured out what it takes to be successful and don't bang on the table to get what they need. I think often CFOs feel like, gosh, I'm telling everyone else not to invest in software and I'm telling everyone else to reduce the amount of headcount. But I think seasoned CFOs need to know, for this size company, this complexity, what is the resourcing I need, the system, the process, the programs, the tech, and the people. It's still a org issue. And if you don't set yourself up for success, like that's can be a death knell. One thing about Maxio we talk about is my CFO today is a seasoned CFO, has worked at multiple companies, also has been at PE firms, both Vista and Marlin, so has a broad perspective. And he would say at a company our size, with the complexity, the number of customers, number of bills that go out, he would need a team of 12, and we're operating with 6. And that's the advantage of Maxio being able to help support the collections, payments, all of the AR, et cetera, and the reporting. Now, should we have 7? Maybe. And so, he and I have been having conversations like, yeah, we probably do need to invest in FP&A, is the one that we've been talking about. But I do think CFOs need to really be deliberate and intentional about what do they need at this stage where we are and what's going to get them to the next 20 million or the next 30 million, and have that be part of the long range plan that you put together. Well, great. Well, Dave, this has been awesome. So just like to close out with our speed round. Speed round
Sure.
includes 3 things. Favorite metric and why. Your favorite book. You got lots on your bookcase back there. I'll be interested to see which one. I love Traction. The other one's Execution. Oh, yeah, you got great ones. But what's your favorite book and why? And then your favorite influencer. So someone who you like to read, who you think is actually generating new content versus just cycling on the content that's going around the echo chamber.
Sure, good questions. But I've got a kind of a fudge answer for the favorite metric, because really It's like whatever is the relevant leading metric for that business. So the lagging ones are great, but really it's about the lagging ones are great, but really it's about usually something go to market. Usually, quite often it's like what's actually happening. But that's the stuff that I think really helps just build a good, healthy rhythm and cadence within a business. And predictability as a CFO, I think, just helps you sleep better at night. So, like, whatever's going to give you the most predictability from the go-to-market motion is kind of like my favorite metric.
That's great. I really like that answer. A lot of people say ARR or gross retention or net retention, but I think your point in terms of you're trying to build a growth business, because that's what's going to drive the valuation. What's the indicator that all the effort and energy you're putting forward is impacting the leading indicator? I love week over week pipeline as one of those. Yeah. But yeah, great. Okay, so favorite book.
So yes, I do have a bunch of books on my shelf. I do love The Advantage by Patrick Lencioni. But I should take this opportunity to plug my book. So actually, in my spare time, I write fantasy novels. So check out my book, King's Hold.
King's Hole?
King's Hold with a D at the end.
Hold. Oh, okay, right on. I'm a huge fantasy science fiction fan. So yes, I will. Did you self-publish it? Did you get a publisher? Like, what's the...
I did.
You find it on Amazon?
I self-published. Yes, it's available on Amazon. So I've got 4 novels that I've written kind of over the past 6 years. So.
Oh, have you really? I had no idea. That's wonderful. Congratulations. I started 4 books and never finished any of them.
Oh, well, we can chat about that separately if you like.
We can chat about that at some point. I got this one that I'm putting together and I can't get the darn thing across the finish line. So I will follow up with you on that. Okay, cool. So King's Hold with a great author's name, Dave Woolliscroft. So it must be good. Okay, favorite influencer. Who do you follow and who do you like?
So on LinkedIn, I really like from the Top Line podcast, Sam Jacobs, AJ Bruno, and Azin Zamari, right? I think, but Sam I think is great, and I just also. It's funny. More as a finance operational guy, I kind of feel like I'm doing a little bit of like inside baseball from the go-to-market side, and I both learn a lot. But I love the fact how they've become so focused on profitable, efficient growth over the past year, and so I think there's just great wisdom for a lot of founders out there, whether you are financially sponsor backed or not. but being able to make sure that you're getting the right efficiency from your dollars, and how do you build a business that's going to be, long-term accretive and sustainable for you, it's good. So I would definitely recommend Top Line and Sam.
Top Line. It's called the Top Line Podcast.
Top Line Podcast. Yeah.
Okay. Well, we'll put that in the show notes. And then if people want to get in touch with you, Dave, either looking for some advice, because that's what you do these days at Exit Point Partners, or want to catch up on fantasy novels, is the best way to track you down on LinkedIn? Or do you have your own website, or what's the best way for people to get in touch with you?
LinkedIn is good. I do have a website, and there's a forum on there too. I just realized now that I have a very long name, and also a very long name for the company too. So I didn't really help anybody out there, but yes, you can find me at both places.
Awesome. Well, thank you again for your time, Dave. I really enjoyed the conversation. I look forward to reading your book.
Thanks. Cheers, Randy. I enjoyed it too.